you can now do call centers, so they're much more automated. We're getting to a place where call centers will be done by artificial intelligence probably. But also just go to a fast food restaurant, which of course I never do anymore at my age. But if you go to a fast food restaurant, a lot of that is, and I've seen this in airports actually. You don't necessarily need somebody to take your order. You've got a nice menu. You punch a screen and the food appears. So, and there was tremendous incentive to do that when there weren't any workers. You saw stores that didn't have very many people in them and that sort of thing. So I think that's an example that we saw. Artificial intelligence pre-generative AI is used all the time by big companies and modest-sized companies too, and it's certainly having an effect on productivity. Generative AI is just in the early stages, and certainly the companies and the banks in particular that we deal with are not really using it yet. They're not really deploying it yet, and they're very aware of the risks in it. So, but over time, I mean, you can find estimates from credible organizations that generative AI will create a burst of productivity, a large burst of productivity in the next decade. You can also find skeptics, very credible skeptics who think that that's hugely overdone. The history has always been that there's innovation, there's technology, it doesn't show up in the productivity statistics at all, and then it shows up a lot, but much later. So it's usually later and bigger than we expect. That may be the case here, because this really, it is an extraordinary set of developments, and the ability to replace a lot of work that's currently done by humans, including well-educated humans, is obvious. The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully.
Point where deficits and debt get so high that it makes your job harder, essentially. That makes it harder for the Fed to achieve its goals.
So we're not at that point now. I want to be clear that we're not in any way taking into account fiscal issues when we make our. Let me say it this way: the debt issue is not an issue that is guiding us in making our economic judgments. Fiscal policy can, of course, affect the economy. First of all, it's not. We do not have a role of supervising the elected branches that do fiscal policy. In fact, it's the other way around. So we don't give them specific advice. But as I have often said, and as all of my predecessors have noted, the U.S. federal government budget is on an unsustainable path. It's not that the debt we have is at an unsustainable level. It's not. It's that we're on a path that's not going to be sustainable. We have a very large deficit at a time when we're at full employment, and I would just say we know that we're going to need to address that, and it's going to need to be done sooner or later, and sooner is better than later. But I leave it at that.
When shocks hit the market, and if so, how might the Fed respond?
Well, the functioning of the Treasury market is incredibly important, and it does function very well. It's the most liquid and most important, probably, financial market in the world, certainly one of the most important. And we did see some, at the beginning of the pandemic, you may remember that the Treasury market lost function because normally in an emergency, money flies into the Treasury market, but the pandemic was such an unusual event. People didn't want to own longer-term securities. They only wanted to own effectively cash. And so we had to jump in and support that. I think more broadly than that, it's just important that the Treasury market remain well-regulated, and that companies have an incentive to do intermediation in the Treasury market. It's relatively low risk. It's very important for the economy. And it's important that be the case. Credibility is really everything in our work. And I think, as you know, inflation spiked really globally, all around the world, as the economies around the world reopened after the pandemic shut down, and on the back of a lot of fiscal and monetary stimulus. We saw a burst of inflation all around the world. And what happened is we raised interest rates to bring that down, but the public had faith. We measure inflation expectations many different ways, surveys and based on market-based instruments, and they all kind of showed the same thing, which is the public all through all this believed that we would get inflation down, that we would restore price stability, which we define as 2% inflation. And that's ultimately the key to it. Inflation is a social phenomenon. If people believe that inflation will be higher, then it probably will be. And if they believe that inflation will come down, then people who make and take prices and wages, they will make sure that it does come down. So it's absolutely critical that we be credible. And part of that is that we responded so forcefully when it became clear that inflation needed a response from us. We responded quite forcefully, and we think that helped keep inflation expectations anchored, as we say. And we're in a different situation. The debt situation has changed substantially, and you're right. We're not, 6 years ago and such, the inflation was really low, and inflation expectations were low. And now we've come way back down, but we're not back where we were. It's a different situation. Inflation is still running above 2%. But we'll take all of that into account. I tell you, though, the answer isn't obvious until we see the actual policies, and even then it's not obvious. So I just think we reserve judgment until we actually know what we're talking about. And I don't want to speculate. I don't want to guess. I think it's more important that we wait and see what actually happens. We can do the arithmetic. If there are fewer workers, there'll be less work done. But we don't. It gets too close to, I just don't want to go there. This is getting me into political issues that I really want to stay as far away from it as I possibly can.
Trend. I think 8 out of the last 9 quarters GDP growth has been above trend, largely because of productivity. To what do you attribute that?
So this is something people will be arguing about in decades from now, but I would give you 4 or 5 candidates. So one of them is that in the pandemic, people started a lot of businesses, and that many of those fail fairly quickly, or don't turn out to matter. But when there's a burst of activity in starting businesses, there tends empirically to be higher productivity because many of these are technologically driven, or the use of technology is pushed out into the society. So that's one. Another is that unlike a lot of our, for example, European countries where they kept the labor force in place, here people had money from government transfers and also from forced savings. They couldn't travel, they couldn't go to restaurants. And so they quit their jobs and they went and found other jobs. And so there was this huge reallocation of people from jobs that they actually didn't want that much to jobs that they wanted more. And we think that's a real factor in this. In addition, given the tremendous labor shortages, a lot of time and effort went into supplementing and people's technological capabilities in ways that substituted for labor. So there's a lot of that.
Likely to have on the macroeconomy in the near term.
So before I answer that, I do want to say that immigration is a question to be addressed by political authorities using such values as they deem appropriate. We're looking at the macroeconomic effects and reporting on them. It's not a question of judging. We don't have a view on the right level of immigration. That is for the voting public and their elected representatives. Okay. But what we saw over 2023 and 24 was a surge in immigration, and also a surge in the labor force, and it certainly pushed up economic growth, and it may or may not have had some effect on getting the labor market back into balance. It'll take time to really understand that, but it certainly made for a bigger economy. And we're coming off the back of a severe labor shortage, so there was room at that time for people to get work, and they went to work at roughly the same level as non-immigrants went to work. So that happened. Then the rules changed. The current administration, the Biden administration, changed the rules a few months back, and we've seen that come down. These are judgments that get to be made by elected people about what the right thing for the country as a whole is, not by us. But you ask what the effects will be. You will see. Really, there have been 2 supply side things that have been pushing up U.S. potential output and actual output. One of them is just more workers, and the other one is productivity. And the more workers part of it is probably diminishing in its effects. And so that won't be something that's pushing up overall output. At the same time, the number of job openings has come way down. So it's not clear what the overall effect will be on there's about one job opening for every unemployed person now. In terms of productivity is incredibly important. That's just output per hour. And if you think about it, higher output per hour is really the only way for incomes to go up over time among the public. And we've actually had, for the first time in a while, a few years of higher productivity, going back 5 years now. This is incredibly important and very positive, and we hope it continues. And there's no reason why it can't. I will say, though, that over the past 50 years, if you look at it, if you have 1 or 2 or 3 years of high productivity, it tends to revert to the trend really quickly. Because it tends to be driven by longer run things like evolving technology and evolving educational levels and things like that. So you don't tend to get big increases of productivity that are sustained very often. It's quite rare, although it has happened. To do intermediation in the Treasury market. It's relatively low risk. It's very important for the economy, and it's important that be the case.
In the March 2020 episode that you're referring to, the Fed ultimately had to step in as a lender of last resort. Would the Fed do that if there were similar disruptions in the initial issuance of treasuries? That was in the secondary market, as I recall.
We're not a fiscal actor, so that was a situation where we have a mandate that we share with other agencies to look after the financial stability, and part of that is if really important markets break down, and they kind of all broke down at the beginning of the pandemic. They just stopped working. And so we set up a series of facilities to backstop those markets, but they actually didn't get used because just the fact that we had the facilities restored credibility and the markets started working on their own. It was remarkable. So in the case of a financial stability event like that, or the global financial crisis, where really the whole global financial system was at risk given the failure of a number of large financial institutions around the world, in those kinds of things we can use these emergency tools, but they're not for every event. They're really for financial stability events.
You mentioned that it's a little bit too early to know what policy beyond the remit of the Fed would look like. We don't know exactly what the fiscal picture will look like, but we do know directionally that tariffs are likely to go up, right? Even if we don't know how much, we don't know necessarily if it'll be exactly what was described on the campaign. And I'm wondering how you're thinking about that. Go on, sorry.
So what matters for us is we don't stand in judgment over these policies in any way. What matters for us is to what extent will new policies have an effect on our mandate goals of maximum employment and price stability, and do we need to change our policy because of these changes in order to achieve those goals? And that's the answer to that question is not obvious. Let's say that there will be some tariffs. We have no idea what that's going to look like. That's one thing. Another thing is, what about retaliation? That changes the picture. In addition, that's happening at a time when there could be fiscal policy, which could be supportive of the economy. So what's really the net effect? We don't take one piece of this. We're looking at the whole economy. In addition, remember, this is way over a $20 trillion economy. Many, many things affect the economy all the time. It's not that common that changes in government policy have immediate effects in the achievement of our goals. That could be the case. And of course, we will use our tools as we're supposed to do to foster the achievement of maximum employment and price stability. That's what we do. That's what we always do. And we'll do it here. I'm just saying we're going to be careful to wait and better understand the net effects of these things as those things affect the achievement of our goals.
Welcome to the Crypto Teacher. And I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And make sure you join the Patrons. If you're not a part of the Patrons, make sure you're hitting the Cash App. And also, guys, make sure you go like and follow the TikTok. More videos to come. And we have Jerome Powell in the house. And once again, guys, he gives us some truth. Not the whole truth, but he gives us some truth about the economy. And yes, you heard that correct. The robots, algorithms, and drones are going to take a whole lot of jobs. He stated that call centers can easily be taken over by AI. But remember, Andrew Yang told us that a long time ago. And he says that there's no rush in cutting rates. And I told you what I thought about them cutting rates. If the labor number is pretty good, they'll pause. Now, of course, we still have sticky inflation. If the labor market comes in okay, not great, but just okay, they'll pause in December. Now, of course, if it comes in like it did last month, they have no choice but to cut. But remember, they want rates high because higher for longer destroys this legacy global economy. And when the Fed does cut rates, we know a lot of that money, those trillions of dollars sitting in those money market accounts, are going to move over to the emerging markets. Because if you look at the dollar, how strong it is right now, it's hurting the emerging markets. And of course, they're moving over to stable coins. And we know the rise of the China's digital yuan backed by that digital SDR with the BRICS nations. They're going to be leading this fourth industrial revolution. Now, Powell did stick to the point that the economy is doing great. And we know that's definitely not true. And he talked about Trump's immigration plan. Now, we know Trump stated that he was going to be forcing out the illegals, and we know that's almost impossible. And he only got 4 years. Remember that, guys, only 4 years. But he's given the mainstream media a point to sell the sheep that we don't have workers. So that's the reason why they're going to be bringing in the machines. And remember, the crypto teacher told you. Because he knows when it comes to the NWO, it's all planned out. You have a wonderful day.
If there are lags between the time that we hit the neutral rate and then we can see it in its works, does that increase the risk for policy errors?
Let me just take a second and explain. So we move interest rates up and down, but what is high and what is low? Compared to what is the question? You have to have an estimate of something that's kind of neutral, something that a level of interest rates that's neither pushing the economy up, supporting it, or dragging it down, which would be higher restrictive policy. And we fully acknowledge that there's no sort of either theoretical or empirical way to arrive at an estimate of what the neutral rate is that you can really have a lot of confidence in. So what does that argue for? It argues for moving carefully. So in our current situation, we feel like our policy is restrictive. We can't say exactly how restrictive it is. By that I mean it's weighing on economic activity and lending, hiring and all that, because the economy was overheated and now it's cooling down and it's moved pretty much as we had hoped it would, which is that we've had a gradual cooling in the labor market. Inflation's come down a lot, and the labor market's not quite stabilized, but it's in a good place. So it's actually worked very well. So we started the process of cutting rates and moving back down toward neutral. I think the right way to find that level is carefully and patiently. You don't want to move too quickly. You may have to move quickly because if the labor market were to begin to deteriorate in a serious way, we would want to get ahead of that. But we're not seeing that. So I think what it tells you, as Catherine pointed out, we think that policy works with long and variable lags, to quote Milton Friedman. Monetary policy does have effects on economic activity, hiring and all that, but with long and variable lags. And that makes it all that much more difficult to know how far to go. I think in this situation, what it calls for is us to be careful, move carefully, and as we sort of reach the range of, or get near the plausible range of neutral levels, it may be the case that we slow the pace of what we're doing, just to increase the chances that we get this right. We're navigating between, as I mentioned in my remarks, the risk that we move too quickly, the risk that we move too slowly. We want to go down the middle and get it just right so that we're providing support for the labor market, but also enabling inflation to come down. So going a little slower, if the data let us go a little slower, that seems like the smart thing to do.
So you say that interest rates are still restrictive right now. But if you look at the CPI numbers that have came out recently, or today's PPI numbers, core CPI is over 3%. I think when I looked, The 1 month rate is higher than the 3 month rate, which is, I believe, higher than the 12-month rate. The economy is booming. The market is on fire. Core PPI came in above expectations today. Business formations are up. Why are we cutting rates? It seems like the economy is doing pretty well.
The economy is doing very well, and that's a great thing. We totally welcome that. But look at the labor market. So what we've seen is a lot of the great data that we've seen has been because of the expanding supply side. Unemployment has moved up from 3.4 to now 4.1. By a significant number of indicators, it's still cooling. Our mandate is not for growth, it's for maximum employment and price stability. But on the inflation data, so we do see inflation continuing on that bumpy path I mentioned. Today's reading was slightly more of an upward bump than we had expected. But I would say the broader trend, if you look back over the last 18 months, we think that's still intact. We're going to tear this report apart and look at all the details. We'll get another report in December before the December meeting. We'll get another labor report. We'll get the final numbers for October by the end of this month, and we'll look at all of that. We'll make our assessment. We do believe policy is restrictive, and again, I would point to the labor market, but it's not clear how restrictive it is. That's a very fair point, and we're well aware of that. And I think we're mindful of the risk that we go too far too fast, but also of the risk that we don't go far enough. It doesn't seem like that's where we are either. It seems like we're right where we need to be. I mean, I do feel like the U.S. economy is in a very good place, and I feel like our policy is in a really good place. We've got a lot of space to cut rates if the economy weakens. In the meantime, we can take the process of reducing rates. We can be careful about that, and that's what we're planning to do. A global pandemic and its aftermath, and is now back to a good place. The economy has made significant progress toward our dual mandate goals of maximum employment and stable prices. The labor market remains in solid condition. Inflation has eased substantially from its peak, and we believe it is on a sustainable path to our 2% goal. We are committed to maintaining our economy's strength by returning inflation to our goal while supporting maximum employment. The recent performance of our economy has been remarkably good, by far the best of any major economy in the world. Economic output grew by more than 3% last year and is expanding at a stout 2.5% rate so far this year. Growth in consumer spending has remained strong, supported by increases in disposable income and solid household balance sheets. Business investment in equipment and intangibles has accelerated over the past year. In contrast, activity in the housing sector has been weak. Improving supply conditions have supported this strong performance of the economy. The labor force has expanded rapidly, and productivity has grown faster over the past 5 years than its pace in the two decades before the pandemic, increasing the productive capacity of the economy and allowing rapid economic growth without overheating. The labor market remains in solid condition, having cooled off from the significantly overheated conditions of a couple of years ago, and is now, by many metrics, back to more normal levels that are consistent with our employment mandate. The number of job openings is now just slightly above the number of unemployed Americans seeking work. The rate at which workers quit their jobs is below the pre-pandemic pace after touching historic highs 2 years ago. Wages are still increasing, but at a more sustainable pace, and hiring has slowed from earlier in the year. The most recent jobs report for October reflected significant effects from hurricanes and labor strikes, making it difficult to get a clear signal. Finally, at 4.1%, the unemployment rate is notably higher than a year ago, but has flattened out in recent months and remains historically low. Turning to inflation, the labor market has cooled to the point where it is no longer a source of significant inflationary pressures. This cooling and the substantial improvement in broader supply conditions have brought inflation down significantly over the past 2 years from its mid-2022 peak above 7%. Progress on inflation has been broad-based. Estimates based on the Consumer Price Index and other data released this week indicate that total PCE prices rose 2.3% over the 12 months ending in October, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Core measures of goods and services inflation, excluding housing, fell rapidly over the past 2 years and have returned to rates closer to those consistent with our goals. We expect that these rates will continue to fluctuate in their recent ranges, and we're watching carefully to be sure that they do, however, just as we are closely tracking the gradual decline in housing services inflation, which has yet to fully normalize. Inflation is running much closer to our 2% goal, but it's not there yet, and we are committed to finishing the job. With labor market conditions in rough balance and inflation expectations well anchored, I expect inflation to continue to come down toward our 2% objective, albeit on a sometimes bumpy path. Given progress toward our inflation goal and the cooling of labor market conditions, last week my Federal Open Market Committee colleagues and I took another step in reducing the degree of policy restraint by lowering our policy interest rate by a 0.25 percentage point. We're confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained with inflation moving sustainably down to 2%. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks to both sides. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. We're moving policy over time to a more normal setting, but the path for getting there is not preset. In considering additional adjustments to the target range for the federal funds rate, we will carefully assess incoming data, the evolving outlook, and the balance of risks. The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve. We remain resolute in our commitment to the dual mandate given to us by Congress, maximum employment and price stability. Our aim has been to return inflation to our objective without the kind of painful rise in unemployment that has often accompanied past efforts to bring down high inflation. That would be a highly desirable result for the communities, families, and businesses we serve. While the task is not complete, we've made a good deal of progress toward that outcome. Going to a different economy, and we're going to be learning more about that as we go, but clearly we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction. It's a beautiful future.
Like what you see in China and their social credit scoring systems, right? If we get identity wrong, it could be a tool to enslave humanity. And if we get it right, it could be a tool to liberate humanity. And as an American, I'm obviously rooting for the one that's on the side of freedom.
Bitcoin is an international asset. And also, I do believe the role of crypto is, it's digitizing gold.
I actually believe this technology is going to be very important
Look at it. We have been part of the huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Chinese bank ICBC has been hit by a ransomware attack, and the U.S. Treasury market, as a result of that, has been disrupted. This, according to the Financial Times. We're getting at more right now with Bloomberg's Shonali Basak. Shonali, what do we know?
Listen, we have the Financial Times now reporting that ICBC, one of China's largest banks here, was hit with a ransomware attack. And remember, they're a very significant intermediary in the Treasury market. The SIFMA has told its members that this has been part of the reason here that the system is kind of clogged up, if you will, during that auction that we saw a little bit before. The attack had prevented ICBC, according to the Financial Times, from settling Treasury trades on behalf of other market participants. A large executive at a major bank also telling the paper that such a large party on the fixed income clearing corp creates major concerns, potentially impacting the liquidity of Treasury markets.
Now, it was not just a poor auction. It was absolutely lousy, and when the dealers have to step in to save a Treasury auction, that's a rare occurrence. And
Cryptoteacher and the new World Order book, plus the 3 kids books, is time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get home stocks, the Seaver, the biotech stocks. And while everybody's at home wishing, they were still getting that free money. What are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID 33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.